The underlying fundamentals in this current marketplace look eerily similar in some ways to 2008. And we're talking about the housing market. And we're talking about specifically cash out refinances. And some of the latest trends we're seeing, borrowers are possibly going back into this concept of using their home like an ATM all over again. And today we're going to discuss what are the statistics about it saying about how it'll affect the future value of real estate. Let's get into it. So Housing Wire just came out with an article that says underlying fundamentals are significantly different than what we saw in the early 2000s. But they're hearing a lot of chatter about the boom in cash out refinances. And the presumption seems to be that it's destined to wreak havoc on the housing market and the economy at some point. Yeah, so Freddie Mac just put out a bit of data that Housing Wire reported on. And obviously towards the end of 2020, people are borrowing a lot of equity out of their homes. Now, this is still not where it was at the peak. I mean, obviously you can see in the same graph that this raging area right here throughout the middle, throughout 2006, 2007, there was multiple more amount of money taken. I mean, talking like 50 billion on one, and from our last quarter and in 2007. You can see by the graph, this is over 100 billion in a single quarter. So you have double the quarterly cash out refinance, people taking cash out of their house. The reason why this is troubling is because the more money borrowed, it creates a couple different effects. Number one, it creates an increased payment, okay? And number two, it creates a loss of equity. So you're reversing equity. You're basically borrowing against value. You're taking out more money out of the home itself. And then conceivably, if there is trouble, you're kind of creating two factors that are dangerous at the same time. You're increasing the value, what the home is, what's owed against the house that has to be paid off in sale. If there is duress or some issue, you have to sell the house. But then you've also got the situation where the payment is jumped. So, one might say, this is dangerous. This is a sign of issues, of things to come. Would you agree with that?
Yeah. Well, I would say that the overall context of last year is definitely important to take into. I mean, if there was a year to take out money out in an emergency, it was 2020, right? A lot of people lost their jobs. A lot of people had to move. A lot of people, it became just a primary issue to pull out money to make the home nicer, because now a lot of people had to work from home. When people needed money, they looked to their home. They cashed out 80% of the value, which is actually, that's all the cash out refinances will let you go up to. They won't let you cash out refinance 100% of the value. They'll go up to 80% because they're banks, they're money, they're experts at money, right? So it's all being done safely, and I think taking into context the COVID market, I think it just makes sense. Something to note here is that people are sitting on a lot more equity than they were at the bubble. During the bubble, at the peak of it, they were at $4.6 trillion in total equity in the market. Total equity, right? The whole market had that much money. It didn't even reach 5. Right now, in our market, we're sitting at $7.3 trillion in cash-outable equity, if that makes sense, right? So we are sitting on a lot more money. So seeing a small bump in the overall scheme of things, we're actually in a pretty safe. I mean, if there is going to be a crash, I don't see why, since homes really aren't overpriced. We're not seeing the mortgage fraud that we saw. And this we're going to go back and forth, but I mean, we're not seeing people qualify for homes that they're not actually qualified to own, right? And qualifying for payments from banks that they should never have had, just like it happened just a decade ago, right?
Well, so here's the thing. It's fine to say that lending is more stringent than it was before. That is true.
Big time.
So easy lending allow people to really kind of use the home as an ATM, if you will. But here's the thing. One thing that is a concern is the home values are in a runaway train kind of thing right now. You have home values escalating beyond belief. So for instance, if you have some of these housing graphs, for instance, you could look at anywhere in the United States, you could look at the Central Florida housing market over the last 5 months. It's like SpaceX, Elon Musk and the rocket going straight up.
Yeah.
Like it's vertical. You look at Canada, it's vertical. You look at other countries, the housing markets are vertical.
Yeah.
So what happens is what goes up seemingly must return to planet Earth. If you are now lending on loans that are, you're creating new math, even if it's 80%, if your value jumps so fast, so you have 10, 50. I mean, I looked at some numbers with just Lake and Orange County, and you had $60,000 price increase across an average section of homes. So you had a 20% jump. It's like 330 to 390 across 2 counties I'm looking at. Okay, so that will immediately, according to lender numbers, they're going to pull an appraisal. If last year it would have appraised at 330, this year appraised at 390. What my point is, you're now taking and you're creating a loan at a percentage of a value, a target value, that are red hot. Yeah. So that does create more of a risky loan. Okay. Yeah. Now, yes, we are more conservative on the mathematical equations of how we're getting to give people money. That is true. Okay, I do not disagree with that. But I am saying that things are changing so fast. Here's the challenge too. Think about how fast these ratios are climbing. Okay, so you have math going up on what a house is worth, math going up on what you can get lended on it because the amount is higher. Mm-hmm. But that number is getting moved much faster than the actual rate of wages. So living wages are like this, and then prices are going up and borrowing is going up.
Yeah,
that's not a good thing, because what that says is, interest rates are down, so it does create a lower payment against the debt you're borrowing and all that kind of stuff. But you are still increasing your payment. You're going to borrow some money out.
Right.
People took $50 billion out last quarter. That now means they all have higher payments. Now, if they were borrowing because they were in trouble, or maybe there's a lot of people that were just adding on an office for themselves,
right,
a dance studio, a fitness center, or whatever.
Yeah, they move their parents in. They got to make the house more accessible for their parents. Makes sense. What I would like to compare, and just to kind of balance things out here, is just to show you some raw data, and we can pull this up on the screen. From 1985 to 2000. The percent of the median income needed to purchase a median price home, right? So that the average buyer making the average income on an average home, the price of the mortgage of the home was 21.2%. During the bubble, it was 25.4%. Right now, in today's market, we're at 14.9%. People are very comfortable with the mortgage payments. Interest rates are low. Homes are still on the incline because we're in a recovery from the crash. So we're making up for lost time. Right now, the fact of the matter is we're actually qualifying people for homes that they're very, very comfortable paying right now. And I don't see any trouble here when we're comparing this to the market, or even the actual historical norm from all data collected. We're at 14.9% of the median income goes towards somebody's mortgage. That's pretty comfortable to me if you think about it. That's 1 in 7. That's 1/7 of people's the median income going towards somebody's mortgage. I mean, people are wanting to qualify for more. I mean, bigger homes are more popular now. People are not just living at home now. Now they're working from home. They're starting their own businesses from home because they're seeing that a lot of businesses failed, but now a record-breaking amount of businesses have opened because of that. This is an incredible comeback that we're seeing. People are using their homes in different ways, and it's just incredible to see how America's bouncing back. So
listen to this. So I was actually doing some research on the topic of cash out refinances, and actually it's not easy to find a lot of data on exactly how much of this is turning over recently. Yeah. But there is a guy named Nikolai Rusanov who is he's a Wharton finance professor, so Wharton Business School, and I believe he's out of University of Pennsylvania. And his co-author, they wrote a paper. They did a ton of research on refinances going into housing crashes, say recessions. And what he said, let me read the article from Wharton UPenn. He said, he starts off by talking about how times past, people started using their home as an ATM. He said, that's what happened a decade ago when the housing market collapsed. Yeah. New research from the same guy, Wharton finance professor Nikolai Rusanov, shows that the pattern wasn't particular to that one recession in 2008. He says, looking back 30 years, Rusinov and his co-authors found a cyclical pattern of refinancing before each recessionary period. Now, if that is true, right, and you stare at this graph, okay, let's all stare at the graph. Right, where's the last recessionary pattern? So you have, you had a blip at the end of the dot-com bust here going into 2000, but then going into 2007, 2008, it just never stopped. And I mean, as you can see, in the early 2000s, you had a trend, according to Freddie Mac, of cash out refinances, just taking off early. Now, it took, from 2002 to it took 6 years of people piggy banking the house, cash out, ATM, taking tons of equity out before anything happened. Okay, so you got to look at this. There's no question that in the last year, the climb has gotten much steeper. The volume of cash coming out has gotten much higher than it has at any point in the past 10 years since that time. Okay, we're at record levels post Great Recession. Okay, that's true. But at the same time, if you look at this, there were steep climbs, then there were some more descents, and then there was more money. Okay, so with all that being said, recession may not be around the corner. Like, it may be, we might be at the start of 5 or 6 years it takes to actually formulate a bubble if it mimics last time. Because clearly, in the early 2000s, the market was, felt the same, super hot, a lot of action going on, a lot of appreciating, a lot of, the same experiment we're seeing in the marketplace right now. Similarities. However, it did not disrupt overnight. Did not fall after the cash out started.
Yeah. There was a lot of fraud, and I mean, I think the last crash had everything to do with real estate. So I mean, it's tough to kind of make a one-to-one draw, because people were they had adjustable rate mortgages. They were qualifying for 2, 3, 4 mortgages. You could write a mortgage up for somebody's dog. It was nuts. It was the wild, wild west of mortgage lending. And so, I mean, it's tough to say, because the market was going so crazy up. I mean, the market was not, even the market appreciation was not as high, was higher than when we're seeing now. So if we look at the numbers, in 2002, the annual home appreciation of prices went up 8.5%. 2003, it was 8.7. 2004, it was 12.5. 2005, the market went up 11.4%. These are insane numbers. Right now, we're seeing, in 2017, it went up 6.4. 2018, 4.8. 2019, 4.7. Last year, it was a big market. It went up 9.2%, right? So, I mean, we're not seeing the level of appreciation that we did back during the bubble. And also, like we were talking about, mortgage lending standards are much higher. I can pull up this graph too. It shows the actual, it's from the Urban Institute. It shows the amount of risk that the lender takes, that a product it actually has in terms of offering it to the buyer, in terms of lending standards. Is it below or above reasonable lending standards? Is it very hard to get a mortgage, or is it very easy? And it shows that number is actually going down right now. It's actually getting harder to qualify for a mortgage, just based off of lending standards, because, I mean, it just makes sense. The home prices are going up, and the bank's going to want to protect their investment. They don't want a bubble crash like the last time, if that makes sense. So it's harder to get a mortgage. I think we're in a much stronger market than we were then, and we'll pull these graphs up so you folks have access to them as well.
And you don't need to worry, because the people that run everything are way smarter than we give them credit for.
Yeah.
They wouldn't make a mistake.
They don't. No,
we
can trust the government. The government's good.
The central planners, we're in good hands. All right, listen. Yeah. So that takes me to that's a segue. With one of my friends, a good friend from Las Vegas, I'll quote Steve Hawks. I might have just gotten my video taken off of YouTube by saying his name. I'm just kidding, Steve. Steve Hawks said on March 18th, people have to realize it's not about the housing market going up. It's about the value of their dollar going down. They're correct about a crash, but it's not housing that's crashing. It's the dollar that's crashing before our eyes. Buying a house or any hard asset protects you against inflation and the wild printing press of central banks around the world. So Steve said that inflation is getting out of hand. The dollar is becoming eroded. People are basically getting less for their buck. People are looking for protection. Now listen to this. Last month, Federal Reserve Chairman Jerome Powell said the current state of the housing market is downright unsustainable, and that is likely to calm down in the near future. And it's really interesting because if you read a lot of what the Fed is saying is they are letting the inflation run, okay? I'm not seeing that there's any standard of saying we're going to rein in this pace. So what is happening? Things are skyrocketing in terms of how much demand you have for certain things. Supply of those items is nothing. There's nothing for sale. There's supply chain shortages. There's cars that are not being produced because they don't have parts for them. There's no houses for sale. Okay, the housing market is the toilet paper aisle of 2020. You have this. This is now not a U.S. issue. Check this out. Reading in the Wall Street Journal, the title of the article is "Canadian Housing Boom Raises Concerns with Homes Selling Far Above Asking Prices." It says just like in the U.S., the U.K., Australia, everywhere else, Canada is experiencing a housing boom craze fed by the COVID-19 pandemic and the demand for more space and rock bottom interest rates, demographics, millennials moving up, and Canada has seen a more dramatic run up in price than all groups of the other 7 countries. Now here's the deal. Every market is local, but if you take a look, I'm going to show you a graph. This is a Canadian entrepreneur. I saw an article on Zero Hedge called "It's Gone Parabolic: The Canadian Housing Price in One Shocking Chart." And the senior economist Robert 𝐊𝐿𝐴 writes in his morning charts that if it's not fully apparent to all parties, the Canadian housing market is boiling. This picture might convey a message. So essentially, if you look at this graph, it's vertical. Like pricing is jumping off the charts. 𝐊𝐿𝐴 said that a 1-month change in Canada is faster than the previous 3-month change. A 3-month back is faster than 6 months back. And 6 months back is faster than 12 months back. And it's saying that the rate is just off the charts. If you look, I've numbered 7 countries, right? All the same deal. Al Jazeera did a report. I guess they carried a Bloomberg reporter, Matthew Brockett, wrote about New Zealand. It says New Zealand government tackles property speculators with new rules. So in New Zealand, same deal. Now they have the same deal that everybody else has. No inventory, no homes for sale. So what are they going to do? They create laws that say if you're a speculator, you can't buy. Or if you do buy, you won't get your tax protections. You'll have to pay like some ridiculous rate, for instance. So then what happens is you have central planning more involved in the housing market than we have in the past. So the question becomes, you've got the Fed. Okay, the Fed is absolutely involved in monetary supply, going back to what Steve said. Okay, you've got governance. Governance, Biden comes in, you can, people go, oh, Biden, he didn't do anything to crude oil. He didn't have anything to do with crude oil. Well, if you look at the election, all the trades started saying price is going higher. Why? Because the future of crude is there's going to be less of it. There's going to be production supply constraints. Biden made moves that affect supply of a commodity. What happens to the future? What happens to its value? It skyrockets. So crude is up like 80%. Lumber is up 107%. It has nothing to do with Biden. It was obviously a Trump era issue. This was from the pandemic. So you have central planners tinkering with the marketplace. So the question becomes, are the smart ones, are they equipped to sail us on a good path? Are we being put on a good path? Because in some ways we are. The habitat, the environment that we're in is kind of created by policy, monetary policy. It's created by lending policy, all those kinds of things. So is that a danger to the outcome of housing in 6 months, a year from now? You have things like forbearance programs, eviction moratoriums. Where do we go from here with all of those things being governed by outside forces which absolutely affect a supposed free market? Yeah.
It's kind of a weird thing for the average person to kind of take in when we talk about inflation, because sometimes people treat like 1 minute this year is the same length as 1 minute last year. So they kind of treat the dollar the same way, right? They treat it like, I had $1 last year, I put in my savings, it's going to be worth $1 this year. Well, the thing is that having an asset, like having $1, year over year, you're losing money because your dollar is losing value. So it's a very weird concept to have in your mind, but I absolutely 100% agree with the gentleman that owning real estate protects you from inflation, because as the cost of goods go up, so does your asset. Your asset goes up, but the dollar is not like that. It's very weird. But I would like to talk about the people that are in forbearance plans, because that's something that it's pretty concerning for a lot of people. It's just forbearances. A lot of people. For those of you that don't know what forbearance is, it's a program that was allowed by the government. Actually, well, we won't get into that, but it was allowed by the government for sellers to have a way of either postponing their payments, so that being underwater, they can kind of breathe a little bit and make it to the end of the recession that was caused by COVID. So a lot of people, they couldn't make payments, they had to postpone them, they had to tack them on to the very end, and a lot of these people have caught up entirely, have entirely paid off their house. A lot of these people are still in trouble. So what percentage of people are we going to see that are going to hit the market because of distressed property sales? And I think that's something that's really important to talk to. And I have a graph here that I actually printed out so that you can kind of see, but we can put it up on the screen too. So if you look here, this is one pie showing all the forbearance programs that were actually taken. It's in the millions. So this kind of breaks it down into percentages. The green are all caught up. Either they paid off their homes or they became current on their mortgages. As you can see, it's about half, right? And then these guys are either in the loan modification or loan deferral program. That means they tacked the missing payments that they made into the end of their mortgage, right? So a 30-year loan, if they missed a year of mortgage payments, that year is going to be tacked on to the very end of their mortgage, if that makes sense, right? So they are current. They do not owe more. They are not delinquent on their mortgage. The only people that are they have no loss mitigation plan or are at risk of going on the market as a distressed sale are these folks right here in the red. And that makes about 15% of all forbearances. 15%, that's 1 in 7. But just something that we can get into here is that if you look at the inventory shortage, this doesn't even make up for the inventory shortage that we have since last year. So this is a graph, right? This is a graph of what we started at every year on the market in terms of homes for sale. This is our actual inventory. Now, if all of the ones in red that I showed you in the last graph hit the market all at once, meaning tomorrow, we wouldn't even make up to where we were last year in terms of inventory. So it's pretty incredible. We are at such a shortage, an all-time low in inventory right now, that the makeup of the homes that would be distressed if they all went for sale at once wouldn't even put us at normal for 2020. So pretty strong market that we're seeing right now. I don't think it's anything to worry about. I think if it all happens at once, I think if the people that wanted to sell last year end up selling at the same time as these new builders start to build, because there's going to be a surge in new builds. So if new builders start selling homes and then these distressed sales start going for sale, and then the people that wanted to sell after the election year start selling this year, then we're going to see something a lot closer to a buyer's market, which is something we haven't seen in a long time, but it'll be pretty fun. But either way, I think it's a strong market. I don't think it's anything to worry about. What do you think?
I would bargain. I would bargain more on the side that the dollar is more in danger than real estate prices. So to summarize it, it becomes to narrow it down, like even what Steve was saying in my first quote that I did bring up, is that if the dollar is in danger, then hard assets become the anchor, right? Hard assets become the safety, or Bitcoin, I guess. But basically, if part of this whole, kind of at the end of all this is, like, I don't feel like there's any dollar protectionism is not high on anybody's radar screen in the planning. So I was kind of like looming around about this idea of central planners and the people that run monetary policy. I don't feel like there's any goal to really at least break the economy, break it, hit the gas, hit the brake pedal. That is. So for them to do that, then what would have to be the outcome in. So what happens if I'm right? Then there won't be any eviction. Eviction will probably get extended in certain areas. You're not going to have FHFA, the Federal Housing Administration that governs Fannie Freddie, who allowed forbearance. Those guys aren't going to come in strong on. If they sense there's blood in the water still, they're going to clamp down, right? Yeah. Proving further the dollar is going to get hammered is Biden's ready to fire up the printing press for $3 trillion more.
Yikes.
Okay, so we're just still printing and sending money to everybody.
Yeah.
Like, have you just opened up your bank account and you see like this deposit from the U.S. Treasury? Has that happened for you?
Not yet. I'm going to get it in the mail, but
have
you?
I won't tell you how much it was. I was like, my wife and me thought it was a mistake. You know, it's like Biden bucks showed up in my bank account. So, I mean, when you start doing that, like, man, the dollar is just going to get pummeled.
Yeah.
So the other thing too is interest rates rose 50 basis points. Like I believe, if I'm not mistaken, they're up half a point.
Yeah.
So they've actually climbed 0.5% on the average.
Yeah.
But check this out. So according to all this, U.S. housing starts were reported after mixed data last month. Starts down, permits up. That was in January. February starts and permits were expected to drop modestly month over month. Instead, they utterly collapsed as interest rates soared.
Wow.
So, housing starts. New permits being pulled by the builders in February hit the ground.
Wow.
If builders don't build houses, what is there a shortage of?
Yeah.
Right?
Yeah,
Less supply.
Right.
Still. So, here's the deal. If I were a betting person, okay, in this moment in time, I do not see the government will put any pressure on any home debtor that would put them in a position where they're going to lose a house and create more supply, which you traditionally think of distressed supply. Mm-hmm. So what will happen? If the dollar keeps getting pummeled, interest rate values are going to continue to climb. Mm-hmm. Okay? Like, the only thing that can slow down interest rates is increased supply of housing.
Right.
And I think, I mean, you could probably jump interest rates another point, and they probably we still have a hard time finding houses for people to buy. Yeah. And if that's if that still is the problem, then housing prices are going to continue to climb. Mm-hmm. You know, so at the end of the day, the central planning aspect in our economy is a huge factor. And I like, it's interesting because that's what the government wants it. I mean, you can tell this. I'm not trying to get off the beaten path here, but like right at the end of Trump era, Trump was really pushing hard for FHFA to release Fannie and Freddie out of conservatorship of the government. Now, when you think about that, when Fannie and Freddie is under conservatorship of the government can have a say in what they do, right? Mm-hmm. So, for instance, if Fannie and Freddie is more independent, they don't answer to any bureaucrat. They only have to worry about who? The shareholder. Mm-hmm. They make wise bets. Yeah. That's irregardless of public policy. Yeah. What happens when you have a government kind of controlled entity under policymakers is they create policy that is not universally concerned about a profit. And so that's where you have risks that get taken that are sometimes outside of the realm of what is really wise financially. To me, that leads me to believe that there's going to be ongoing, there's going to be issues that are not going to be reined in by the marketplace. You're not going to have natural marketplace says, okay, if you do something really stupid with your finances, you fall you hit your head and you run out of money. Right. If you're under the control of the government, then you can fall, hit your head, and get rewarded for it. Yeah. You won't have a loss.
Right. I think we were talking about similar to the Postal Service, right? I mean, they have lost money the last 9 years, the Postal Service has, and it's pretty crazy. They will not raise their prices because they know they're going to get bailed out. It's pretty crazy, and it's very dangerous because at that point, they're not just messing with their own money, they're messing with all of our money, right? Because we're the taxpayers. We're the ones that are going to have to foot the bill for the bailout. So just makes sense what you're saying. Yeah.
But, I mean, so that's it. I mean, all of this, I think any logical person would probably come to agree that obviously the market is not a free market. It's not an open system of unmanaged, it's managed supply and demand. It's not unmanaged, it's centrally managed supply and demand all around the globe, okay? So it becomes bizarre when you see all of the countries dealing with the same exact thing at the same time.
Yeah.
Right? It's all same existence. Pedal down, gas down, car going 100 miles an hour in the real estate market with like, where does the end come? You know, where are the caution lights? Where's the place where you start getting concerned? And I guess we'll have to wait and see, right?
Yeah.
At the end.
Yeah. And it's always better to have an asset than to have a home than to rent. You know, I don't want to make people think that what we're saying is that, you know, the solution is renting. You know, it does protect you from inflation, and you have a consistent payment every single month. You don't have a danger of getting. I mean, it takes almost a year to foreclose on somebody rather than 30 days to just actually kick you out of your home and give you an eviction notice.
Yeah.
So you have more stability. You can change your own home however you like it. You can make it a home office, paint the wall, you know, enclose an area, do things like that you wouldn't have a freedom to if you were renting. So 100% we're not downing, we're not at least showing renting to be the solution at all.
Oh, not
just
at all.
kind of giving people a fair warning.
Be the landlord.
Yeah, be the
I'm not even kidding. Like,
100%. Yeah.
This is, you know, I've usually been not as bullish about owning rental property in Central Florida because of different, you know, forces you have on your profit based on rent and stuff like that. But man, it's going to be really bad. I mean, I think, you know, renters work in dollars and owners work in locked in contracts when they have a mortgage. It's like, this is what it cost me. Yeah. The renter works in dollars, and if dollars get inflated, the renter has no end in sight to what their payment can possibly be in rent.
Yeah.
And I think at some point there's got to be a breaking point. So as prices really skyrocket, Florida is in an interesting time. And I want to shift. Okay, let's shift to really topic 3, which is anyone else concerned about any pop, right? So bubble becomes just price escalation to a point of no return. To it's like, we can't sustain it anymore. And if you look at the chart, like I showed charts earlier in this podcast about New Zealand, Canada. If you pull up Lake and Orange County, which I have another update, which was produced before this video, which you can go online, YouTube, Facebook, and watch that. Orange and Lake County's pricing is like it's the same. It looks the same as Canada to me. Yeah. So when it becomes a situation like we said earlier, where you actually have appreciation outpacing wages, especially local wages. Yeah. Like local wages is not even anywhere in the same trajectory of housing prices. Right. It becomes a situation of what happens to the locals, right? We just listed a property in the low price range, like the entry level of the market. We had 40 showing requests, emails in the first evening that hit the market. Yeah. And I think I'm up to like 90 emails now in day 2.
Crazy.
There's not enough to go around, especially as the market gets more expensive. Florida is unique because while we're getting more expensive, we have an inbound demographic expansion from outside areas that still find our growing, increasing price a value. Yeah. Right? Yeah. So is that a potential for danger in the local market?
Is that a danger?
Yeah.
Our prices
is it going up forever?
Oh,
come on.
I mean, so here's
What's
the weird
the end
thing.
game here?
Here's the weird thing. I mean, everybody has that person that they've talked to that they talk to about how cheap it used to be like 80 years ago. See, that's what kind of makes me doubt that we're getting too expensive. It's because inflation has its trajectory and home values just keep following that. So I mean, I think as long as inflation keeps going up, as long as wages keep going up, I think prices are pretty comfortable going up too. I mean, it's just tough to say. You know, I mean, you used to be able to buy a nice house for $40,000. You know, that's just the bottom line here in this country, and you can't do that anymore. But wages have gone up since then, and the dollar has gone down since then. So I don't know. When do you think homes will be too expensive? Has to do with wages, right? Has to do with the value of the dollar.
You think about how many people you talk to now that are pre-approved for a loan that give up.
Yeah. Yeah.
Okay, so like they literally can go and exit the rent train, but then they shop the market and they don't even want to give it a try.
Yeah.
Right? Yeah. And so it's like, what do you say to that person? Right? How many people And why? Like, why is it someone can actually get pre-qualified and then not want to be in this market? Why do they choose to rent now? Like, because we are seeing this happen.
Yeah.
You know, there's agents I'm watching on Facebook panels where they're like having discussions where they're like, I've released this buyer, you know, because of the lack of emotional resilience required to actually buy a house.
Yeah.
Not knocking the person. It's
Takes
it's sad. It's really hard. It's
Yeah.
not like going to the store and picking out your favorite shirt. Like, you have to pick out a crappy looking shirt, pay a whole lot for it, and then fight another guy to buy the crappy shirt. You know? So it's, but at the same time, you know, what I would encourage people is like, everybody thinks about trying to win the battle right now. Like, I've got to get the right house right now, this time. Forget that. Get on the ladder. Right. If you get in the game and you actually start growing your equity from here to here, then you can actually take equity out. You can sell that home and move it up the ladder to something bigger and better. But if you don't ever get on the ladder, you get left behind in a market like this. Unless you think it's going to crater 20%.
Equity, I mean, you can start building equity now. You can start working your way towards having a house paid off in 30 years. All you got to pay is utilities and taxes. I mean, that's just incredible. I mean, and some people haven't started that journey, and they're, you know, a little bit later in life. Just start now, you know, start now. Work towards that 30 years, and then next year you won't be kicking yourself for not having bought this year.
It's really sad, though. Like, I got to be honest. Like, as an agent, when I start talking to someone who tells me they're a renter in Central Florida, I almost automatically tune out, like, you're never going to buy a house. Like, either you don't have the buying power, or you won't want to use the buying power you have, or you probably don't have the financial backing to do it. Like, the actual, you know, when you compete in a marketplace where everybody's got a lot of cash, if you're broke and you're like, I need help with closing costs, I need help with this, like, those folks unfortunately don't have a prayer.
Unfortunately like they don't.
You know?
They don't.
What do you say to them?
Well, you know, I try to coach them. It's just so tough because it's a mindset thing, right? I mean, I've met a lot of people that are broke, but they make a ton of money. It's the weirdest thing. It's just you make money, but you haven't learned how to save it. You haven't learned how to budget. I mean, some people make their first budget in their 30s. I mean, it's pretty crazy. It's just a culture thing. You know, we think that a credit card is meant for you to rack up debt in. And I think, you know, these people can be coached, but it takes a lot longer than one conversation. So it just takes more time. And unfortunately, this market is too hot for some people. But it takes time. I think those people can make it as long as they save some money, make a budget, limit yourself, know your weaknesses, and you'll get there. You know,
well, you got to be willing to adjust your level of what your definition of what success is in today's market. So you can't be there going, hey, you know what? I'm going to win, and I want this idyllic house. You're not going to get it. Like, you're going to get a much different picture, but you can't get the house you really want unless you actually start the process. And that's kind of like what we kind of say repetitively. And save money. You got to save money as fast as you can. Because if you don't have the cash, the market is dramatically going up faster than you're saving. So you don't have till next year. Like, next year, if we stay on the trajectory we're on, like, you're going to be completely locked out. Which is really sad. So it is interesting that, you know, what we're seeing with our current affordability, like when I'm pulling Lake and Orange and I'm seeing average sale is like high, almost $400,000. Like, on a certain month, you know, it's like, this is the average numbers that we're running. That is interesting to me because you know, if we don't find inventory, right? We don't have supply out here. Builder permits are dropping, interest rates are climbing, it's still hot. Then a year from now, it's well into the 400s on the same type of pull at the same month. And then by then, like, you're guaranteed. So essentially, like, it's not a sales pitch to tell a whole lot of people that are currently renting in Central Florida, you are fast being locked out of the marketplace. Like, really quick. Like, you're within a year, most renters in Central Florida, I would tell you, that aren't very much on the upper level of society in terms of what their income levels are, unfortunately, you're done. And then we're dealing with a bunch of relocators. Like, doesn't seem like that's where we're at. Our market is relocation. So that's the thing, is when we come to the end of our relocation boom, we might actually see a settling of prices. And probably not until then. Because we're going to have the New Yorkers, we're going to have the Chicagoans, the New Jerseyans, all these people coming in, kind of bidding things up and keeping that buoyancy of price, seeing it as a bargain until, I sold my $1 million dump in the Bronx. And now I'm moving down.
I'm going to get 2 homes here, right in Disney.
It's going to be interesting.
Crazy. Yeah.
It really will
absolutely.
be. That's the thing. So it's like, we're working relocations for a good season, most likely in front of us. So here's the thing. Are we possibly in a second boom? Because here's the deal. I'm noticing that people in Florida and people in New York, as it comes to how nervy they are about COVID and vaccination and all this, there's a difference, okay? People from the north seem to be much more scared of COVID than people in Central Florida. You know what I'm saying? Like, this is a reality. Like, I talk to a lot of people that say, I'm not moving to Florida until I feel comfortable.
Right. Yeah.
Is comfortable arriving. And think about that. So if you have a huge percentage of people that aren't here yet, that are coming soon, you have another wave of, in Central Florida, you have another wave of of demand coming. Not supply. You would hope there's supply, but the problem is, I think you've got a big group of buyers coming. So if anything, you've got another massive...
so buy now,
More bubble.
Buy now before they get here, before most of the population takes the vaccine, and people feel comfortable people walking in their homes, and so they can sell it so they can get here. So buy now before, you got to get on that first rung of the ladder, like you said. You can't get on the second one before you get on the first one.
There really is there's a really critical closed door closing on our current locals. That's the fact. This isn't hype. I don't care if you buy with us, buy with somebody else. The point I'm making is, if you are a rental situation in Central Florida, your door is shutting really quick. Really is.
Absolutely.
And I'll lose sleep tonight over it. Get your butt out of your rental.
Buy
with somebody.
Buy with somebody.
Buying or selling a home in Central Florida is expensive. The Jones Group leverages the latest technology and passes the savings on to you. List your home for just 1%. Buying a home, get $7,000 cash rebate before close. Make one call, that's all. Better service, lower fees.